The S&P 500 is the biggest index on Wall Street. It includes 500 stocks of companies from different sectors, making it more diverse than the Dow Jones Industrial Average, which comprises 30 stocks, or the Nasdaq Composite, which tracks 100 stocks. When you invest in the S&P 500, you're investing in a stock market index of 500 large and powerful US companies. So what exactly is S&P 500? Short for Standard & Poor's, the S&P 500 is an American investment information service created in 1957. It is one of the most commonly followed equity indices that measures the stock performance of 500 companies listed on stock exchanges in the United States. Every quarter, its investment committee meets to review which stocks belong in the index based on each company's market size, liquidity, and group representation. Moreover, the index includes companies representing a particular sector in the same proportion of the sector in the stock market. For example, if pharmaceutical companies represent 5% of the US large-cap market, the companies will represent 5% of the market cap of the S&P index too. Contrary to popular belief, the stocks forming the index are not the 500 biggest US companies, but they are arguably the 500 most important companies. As of April 2021, here are the top 10 companies by index weight in the S&P 500. Number 10, Johnson & Johnson. Number 9, JP Morgan Chase. Number 8, Berkshire Hathaway. Number 7, Tesla. Number 6, Alphabet Class C. Number 5, Alphabet Class A. Number 4, Facebook. Number 3, Amazon. Number 2, Microsoft. And number 1, Apple. Because the S&P 500 is weighted by each company's market capitalization, the larger companies in the index can sometimes have an outsized impact on the performance of the larger index. In other words, a big dip in price for Apple shares can create a dip in the index as a whole. Because of this, some investors prefer to purchase the S&P 500 in an equal weighted format so that each company has the same impact on the index. This is meant to create an index that is a good representative of the overall US market. If you're considering investing in the S&P 500, then here are the key steps that you gotta know to get started. Number 1. Open a brokerage account. If you want to invest in the S&P 500, you'll first need a brokerage account. This could be a retirement account like a traditional IRA or Roth IRA, an employer-sponsored 401k or similar, or your own traditional taxable brokerage account. These accounts give you the ability to purchase mutual funds or ETFs, and you may even be able to buy stocks and bonds later if you choose to do so. There are many brokerages to choose from. Look at fees for buying and selling mutual funds and ETFs if you open a new account intending to invest in the S&P 500. Number 2. Choose between mutual funds and ETFs. You can buy S&P 500 index funds as either mutual funds or ETFs. Both track the same index and work in the same way, but there are some key differences you should know about. Mutual funds usually are actively managed to buy or sell assets within the fund in an attempt to beat the market and help investors profit. These funds are intended to be owned for a relatively long period. While on the other hand, ETFs by and large are passively managed as they typically track a specific market index and can be bought and sold like stocks. The price constantly changes throughout the day as traders buy and sell. Most major discount brokerage firms allow you to trade all ETFs for free. There is no minimum time to hold or minimum purchase amount aside from a single share price. If you're buying a mutual fund, then try to find a broker that allows you to trade your mutual fund without a transaction fee. If you're buying an ETF, look for a broker that offers it without a commission. Yes, the best brokers offer thousands of ETFs and mutual funds without a trading fee, but it's totally up to you to decide which is a better fit for your portfolio. Number 3. Determine how much you can afford to invest. You don't have to be wealthy to begin investing, but you do have to have a plan. And that plan begins with figuring out how much you're able to invest. You'll want to add money regularly to the account and should plan to hold it there for at least 3 to 5 years to allow the market enough time to climb and ride out any downturns. The less you're able to invest, the more important it is to find a broker that offers you low cost, because that's money that could otherwise go into your investments. Once you've figured out how much money you can invest, move that money to your brokerage account. Then set up your account to regularly move the desired amount each week or month from your bank. Or you can also set up your 401k account to move money from each paycheck. Number 4. Find your S&P 500 index fund. It's It's actually easy to find an S&P 500 index fund even if you're just starting to invest. Part of the beauty of index funds is that it'll have exactly the same stocks and weightings as another fund based on the same index. In that sense, it would be like walking into 5 McDonald's serving exactly the same food. Which one would you choose? You'd probably select the one with the lowest price, and it's the same with index funds. Once you decide between ETFs and mutual funds and determine how much you can afford, you can start comparing more specific details to pick your favorite fund. The two criteria for selecting your fund are the expense ratio and the sales load. The expense ratio determines whether a fund is cheap, which is the cost that the fund manager will charge you over the year to own that fund. On the other hand, you'll also want to see if the fund manager charges you a sales load, which is a fancy name for a sales commission. You'll want to avoid this kind of expense entirely. Number 5. Buy the index fund. Once you know the S&P index fund you want to buy and how much you're able to invest, go to your broker's website and set up the trade. When you're ready, log into your brokerage account and enter the trade. Stick to the broker's easy trade entry form, which often appears right at the bottom of the screen. Input the fund's ticker symbol and how many shares you'd like to buy, based on how much money you've put into the account. If you're able to move money into other brokerage accounts regularly, many brokers allow you to set up a trading schedule to buy an index fund repeatedly. This is a great option for investors who don't want to remember to place a regular trade. You can set it and then forget about it. As a result, you'll be able to take advantage of benefits of dollar cost averaging, which can help you reduce risk and increase your returns. As long as you understand the risks of investing, it's an excellent first investment and a fun way to get your feet wet in the stock market. So these are the key steps in investing in the S&P 500 index. Now, do you think you should invest in the S&P 500? The benefit of grouping multiple companies into one index is that it makes it easier to invest in all of those companies at the same time. With the S&P 500, you'll be exposed to a lot of great companies over a variety of sectors, which is great if you're looking to diversify your portfolio. It further allows you to own a share in hundreds of stocks, even if you own just one share of the index fund. It is also good for investors who don't want to pick individual stocks. With the easy-to-buy procedures, historically high returns, solid performance, low cost, and diversification, many investors have turned to the S&P 500 in droves. So what do you think? Have you invested in S&P 500, or are you planning to do it anytime soon? Let us know in the comments below. Thank you so much for watching the video. Please leave a thumbs up and share the video if you found it to be useful. For more content like this, click on our channel and don't forget to subscribe. See you in the next one.